Hey, everybody, welcome back to today's Market Explained. Welcome to 2026. This is our first episode of the year, and we want to do a recap of what happened last year and then come up with some new stories about what's happening, review the markets, review the economy, and then things that we see out there. And I'm back today with my co-host. I'm Brian Castle, your host, and I'm back with my co-host, Mr. Chris Reardon. Chris, welcome to the podcast.
Thank you, Brian. Good afternoon to everyone, and glad to be here and do 2026 now, and a lot of interesting things going on in the markets to digest this time.
Well, Chris is our director of development at FourStar. He runs all things portfolio trading, does advisor development, product development, and he's a Clevelander. So he's from Cleveland, loves his Indians Guardians now. And he's a young dad with a daughter and two young twin sons, Chris. Oh my God. Good luck. I hope that's all going well.
Yeah, no, it is very well.
Excellent. And I'm Brian Castle, your host. I'm the CEO and founder of FourStar Wealth Advisors. I'm a financial advisor, but also advisors to advisors, CEOs, and insiders. I'm a trustee of the National Boy Scout Foundation. And I'm chief dad to Quinn and Evan and husband to the amazing Tripty. For our 2026 inaugural show, if you wouldn't mind giving us a 5 out of 5 ranking, go right on Apple iTunes. They have a little button you can smash that says yes. It would give these guys a 5. That would help our ratings. We're still in the top 1% of podcasts in the financial industry in America. We want to stay there and expand our reach. So today we're going to talk about the markets and what's happening. And Chris, you're going to lead that off. So why don't you go ahead?
Yeah, so obviously we're into 2026 now, so we thought we would, start off by covering what happened in 2025, where things ended up. So looking at an asset allocation perspective this time, we're going to do kind of a recap where things change from an asset allocation perspective from the start to end of 2025. So
Okay.
domestic equities started in the first position and it stayed in the first position, but it lost 33 tally points. So it dropped to 296 tally points. Once again, still the number one, but it was, if you really want to look at it, the biggest loser, if you will, as far as the most tally points lost throughout 2025. And international equities started in second and maintained second at the end of the year. It's at 279 tally points, and it was the biggest winner. It gained 55 tally points
Really?
in 2025.
Okay.
So we certainly saw some of that steam that in 2024, I think went to that international equities, which were certainly one of the better performing asset classes, in 2025. Commodities held the third position, no change through the year. So it's started in third, ended in third. It was at 227 tally points, and surprisingly, it only gained 4 points start to finish in 2025. So not a whole lot of change there. Cash was in fourth, started in fourth, ended in fourth at 115 tally points, and it lost 18 tally points throughout the year. So that's good to see. Obviously, cash being lower means obviously more of a risk-on environment, more of a bull market. So that's good to see. Currencies is in fifth, and that maintained that fifth position throughout the year. It's at 94 tally points, and it gained 4 points for 2025. And then fixed income is in last place, started in last, ended in last at 78 tally points, and it lost 10 tally points throughout 2025. So we didn't see a big shakeup as far as asset classes changing, things like that. But obviously, the tally points certainly did change. There were times throughout the year where we thought international equities might overtake that number one position. And there was certainly a time in the year when commodities was more in that, challenging for that 1 or 2 position. But when you really look at it from start to finish, outside of those top 2 asset classes, not a whole lot of change, interestingly enough.
Interesting.
So
Chris, the Chris's international situation, it did gain quite a bit. Yet we look at investors that are invested in dollars. We live in dollars in America. And so if you had dollars and the dollar was weaker, some of the gain came from currency, didn't it?
Well, yeah, I mean, obviously, certainly a portion of that did come from currencies. And I think there's definitely an aspect of that. I think an aspect of that combined with policies that were more growth oriented. I think we saw out of the EU, we saw more defense spending that was being stepped up. There were certainly more things like that that helped propel. We saw Spain for the first time in a while. We saw life out of Spain, that country, and Italy. It was a combination of both, but that certainly was one of the factors that really propelled it as much as it did.
Okay. Very good. All right. So then how about sectors?
So going to the sectors, this was interesting. The number one sector in 2025 was communications. It ended the year up 26.26%. So that really kind of got that strong run there. That's interesting because it's obviously has kind of a tech component to it, but it kind of was able to steer clear of some of the super large tech companies that really got hit towards the tail end of 2025. And that goes into the second best, and that was information and technology. And that was up 21.78%. So still obviously great return. But you can really see a couple of those Mag 7 names, the Palantirs, even the NVIDIAs, kind of dragged on that sector, I think, towards coming into 2020 or the end of 2025.
Mm-hmm.
Industrials was in third at 18.57%. Utilities is in fourth at 16.47%. Healthcare, which was a big surprise, was in fifth, up 15.46%. So healthcare, which was performed extremely bad in the beginning half of the year, had a huge rally for that second half and really came up to challenge in that the top four there. Financials ended up in sixth, up 14.91%, followed by materials in seventh. That was up 12.30%. Energy was up a little over 7% on the year. Consumer discretionary was up 5.76% in the ninth position. Real estate was second to last in the 10th position, up 3.26%. And the dead last performer from sector perspective in 2025 was consumer staples. It was only up 2.17%. Obviously that would be characteristic of obviously a bull year in 2025. Consumer staples are usually more of a defensive asset class. And obviously when you have technology and communications leading the way, it's usually much more of an aggressive year, which we certainly saw in 2025.
So utilities were up 16%, and then they really just kind of fell off, didn't they, near the end of the year? Utilities were leading sectors. In fact, they were the leading sector, Chris, for much of last year. Part of it had to do with the fact of the energy for the AI centers and all the data centers and everything else going on.
Yeah, and utilities were at one point, you're exactly correct, did overtake that number one position, and then kind of pulled back really the last month, 2 months of the year. I still think the underlying trend is still there. I think, these data centers, we have this AI build out, and that's going to consume a lot of energy. And we just at this point do not have enough capability, enough production for that energy. And so that's still probably a good play, but it certainly got overshadowed at the tail end by communications and kind of the tech sector as a whole. Overshadowed it towards the tail end. And the other big factor with utilities that you got to factor in is they're going to be subject to commodity volatility as well. So if gas prices are down, if it's a warmer than normal winter, especially as we're entering December or projected winter, there's a lot of little nuances in there that could kind of negatively impact that in the short term. Doesn't mean it's still not a good long-term investment, but short-term we could see it. I think that did kind of drag it towards the tail end as it that last leg of 2025.
Interesting. And then, of course, consumer staples being the worst. Usually, if the economy is weak, all the other consumer discretionary and business-oriented sectors aren't as good, and consumer staples are better. So that would signal, Chris, that we're probably in a market economic recovery, wouldn't you say?
Yeah, I mean, I think from what this would look at and under kind of a microscope is 100%. I think we're in I'd say we're in aggressive market recovery. Consumer staples are, I mean, it was still up too, but the fact that consumer discretionary uh, beat out consumer staples, I think is obviously promising. I think one of the key trends that we saw especially towards the tail end of 2025. And we'll get into some of the economic numbers, but as the job market started to sputter a little bit, is especially the high income earners, we still saw a lot of that spending, that travel, things like that. And that's why I think consumer discretionary beat out that consumer staples.
Hmm.
And I think the other big factor is I think there still is some shell shock on that consumer staple level for individual purchasers. Inflation is still, especially in the supermarket, still there, especially in certain subclasses of foods, things like that. So, I think you really saw that where people were either cutting back or kind of cutting some of that completely out because, having a $300-400 grocery bill isn't necessarily the most fun thing. So they're either going down to not getting brand name, they're going to the, generic things like that. So I think that's another trend we saw really with maybe the mid to low income spenders is trading off of maybe some of the consumer staples, the Procter and Gamble's, things like that,
Yeah.
um, at the supermarket.
Yeah. So all in all, Chris, it looks like we ended up having a good year, I think. And now we're into the new year, and we started out with a little protection going on in the tech related areas, but that turned around and went back up, didn't it? So we're all on offense right now.
Yeah, yeah. I mean, pretty quickly everything. I think even the last little tidbit of 2025, we kind of got all the green lights. And yeah, it's been for the most part a pretty bullish 2026, I think. A lot of the economic indicators will go into them. There's certainly some that are, maybe a little less optimistic, if you will. But I think for the most part, I think people have been pleasantly surprised with some of the economic data coming out. There's always concerns, and I don't think people, there's geopolitical things going on. There's a million things, but I think for the most part, it's relatively stable, the economy right now. So,
Hmm.
as we've said before, sometimes good news is bad news. Sometimes the market takes it like that because um, if it's good news that everything's going well, then there's going to be less Fed cuts, and sometimes that negatively impacts the market because they're baking in these Fed cuts. Um, which I mean, if they're not warranted, that's a good thing if they don't do them. But we'll see. And I don't expect we don't expect it to be just obviously straight up 2026. I think there's a lot of potential for volatility this year, just like
Hmm.
last year.
Hmm.
But we'll just have to kind of take it as it comes.
Well, we are seeing sectors move around. So utilities led the way for a good part of last year, and now utilities ended, what was it, sixth or seventh sector? So things do change. And if you're in a broad-based bull market, leadership changes. So then a way to get better returns is to follow that leadership. And if you're in the wrong stocks, like some people say, oh, I have to be in Apple forever or Amazon forever. Well, there's long periods of time where they're out of favor, right? Meanwhile, the rest of the market's going up. So we adopt a strategy called relative strength, where whatever's working, we're working in, and we see trends break out, and we see it every week when we do this work. You can find a way to get better returns by overweighting the areas that are working. And these trends don't only go for like a month at a time. They'll go for 6 months, 12 months, 18 months. So you've got some time. The themes develop, and you can overweight in a certain area and do very, very well. And so that's what we try to do. And that's a good part of the strategy. We had really good returns last year, and most investors should have, unless, of course, you just stuck with one strategy, and that strategy ended up weak for the year, like technology, for example.
No, I mean, exactly. I think it's important to note, I mean, these are the large sectors of the S&P. You know, industrials is a great example, I always like to say, because a large proponent of that industrials number is aerospace and defense, or defense in general, was a big driver of that in 2025. So, you know, we can even get a little bit more granular and really focus on the main drivers behind this, and even get, you know, a better return, and not, you know, pick up maybe some factory general, which is doing maybe okay, but isn't the main driver behind that. So really allows us to kind of focus in on what's really working, and cut out what's not working and what's kind of dragging the index behind.
Mhm. So Chris, last year ended up being our third year in a row of double-digit returns. Last year up over 20% in most areas. So that was really great. So investors have been treated pretty well. So naturally, we hear from folks that this is going to be a down year, and right away they're assuming that's going to be the case. So what would lead to a down year would probably be a recession. It doesn't look like that's going to happen, does it? Looks like the economy is actually had slowed down a little bit in the year. It didn't go negative quite, but it slowed down. Now it's starting to reaccelerate. We had a over 4% GDP quarter in the third quarter, and now the estimates for GDP now have gone up over 5% for the fourth quarter, right?
Yeah, I think the US third quarter GDP came in at 4.3%, which was the highest growth in
Mhm.
2 years, and blew away the forecast at 3.2%. So that's good to see. I mean, I think 100%. I mean, I think with what we see right now, things look good. I think the concern, or if there were to be, as far as would be the jobs market, is certainly slowing. You know, I think there are some conditions there that could be causing that, or could be masking. I think AI, you know, there is, I think, this tendency to kind of overstate to a degree AI, but I
Mhm.
do think in the workforce, we are going to see AI pick up that productivity measurement, which has been a big nag on the US for a while. We've been unable to get that productivity measurement up. So, what that really means is you're able to get the same amount of work done with less bodies. And, you know, I think that that's a good thing for the economy overall. I think it's a definitely short-term pain, because, you know, people that got laid off, or jobs that got are going to get, you know, taken over by AI, not necessarily taken over, but maybe absorbed into some type of structure that allows it to be more productive for one or two people. People are going to have to retool their skill set, I think, a lot, and go and see. And what that's going to do is free up some labor to go into different areas to create new things. And we see this all the time when you have a new technology, an emerging technology like this. When we have, you know, telephones, but I mean, there's these breakthrough technologies, and yes, it closes the door on certain industries. I mean, you can look at they still do print them, but it's not what it used to be. Like the white papers, you have the telephone books, things like that. I mean, you're going to close the door maybe on certain industries, but it's going to open up opportunities for a lot of other industries and a lot of other capabilities. And the goal being everyone's going to get more productivity. So society as a whole is going to take a step forward. And
Mhm.
overall, it should be a good thing for the economy, but it's definitely not a linear or straight line, right?
Yeah. Well, and that whole dynamic creative destruction process where technologies change, jobs get obsolete, products get obsolete. You know, the classic is the buggy whips. Buggy whip makers out of business when the auto came in.
Yep.
And that's just a dynamic process that keeps going constantly. And so it can be uncomfortable, right? So people complain, they want job security, they want job training, and but that's always a dynamic process, and workers in the economy need to be ready to continually upgrade their skills and be relevant and make a contribution to a growing company or growing enterprise or whatever enterprise you're involved in, and do some positive things. So you always have to go in with a purpose of being successful and being good at what you're doing. And you know, if your job's eliminated, there's other jobs out there, right? And keep going. Just in our world, in the financial advisor world, I think we've been in 15 different businesses in the last 40 years. It changes constantly. Different products, different services, different fees, different costs, different regulations. It keeps changing. So you just always have to make sure that you're on the cutting edge of what's happening. And then you won't have any problem. But if you don't want to learn, don't want to grow, you could have trouble in any kind of a dynamic economy for sure.
Yeah, I mean, 100%. So, yeah, I think that that's the one area. I think labor market. We do have the manufacturing that slowed certainly a little bit here and there, things like that. But I think the biggest area of, I would say, concern, but where people are really looking at is that jobs area to see how that kind of evolves,
Mhm.
especially for the first quarter or two coming into 2026.
Yeah. So coming into 2026, Chris, the Dow crosses 49,000 for the first time. We're in spitting distance of 50,000 on the Dow, and I can remember back in 2008 when the market bottomed out at 6,500. We're a long way from 6,500, that's for sure. And so things have changed obviously dramatically. And it's been a good era of growth for the economy in the world since that terrible Great Recession of 2008. And then later in the year, in 2025, they passed the one big beautiful bill, which made a lot of tax changes. So the president and the Treasury Secretary, Scott Bessent, have been talking about 150 billion of tax refunds that are coming to a lot of Americans because a lot of the bill rules that came in mid-year were retroactive at the beginning of the year for the whole tax year. So things like no tax on tips, no tax on Social Security. And there's some nuances to that. So it's not automatically everybody has no tax on Social Security. Some of the wealthy don't get that tax break, but many investors and many Americans do. So there is going to be a big amount of money coming back to folks in refunds, record number of refunds. So that's pretty exciting. So the markets are rallying as a result of that. And usually higher markets lead to higher markets, right? So higher highs and higher lows, that's the nature of a bull market. So even yesterday, we came in and there was a proposal from the president to cap off credit card um, interest. So if you have a credit card balance, the interest on your credit card, they were proposing that it cap out at 10%. We all know they charge upwards of 20% or more in some cases. So all of a sudden, all the banks started selling off. We had a really bad, rough start to the year. And everybody's like, okay, here the bear market begins. And that lasted about maybe 4 hours. And then we ended up for the day. So that's what happens in a rising market, in a bull market, that we may have down days, but oftentimes they'll end up, or we may have a sell off for a period of time, but then it reverses and goes right back up. So that's what we're seeing. You can feel a market that wants to go higher. You can feel a market also that wants to go lower. And Chris, we've been through that. The 2008 market and some of the other markets, brutal. Every day the market's down, gets pounded. It rallies, it gets pounded. Same kind of dynamic works the exact opposite way in a bear market. So we feel like we're probably in a bull market right now. We're looking for really strong numbers on the economy. The economy is now recovering and not going negative, it seems. And market multiples are not overly inflated. If you include the high multiples of the technology sector, we're at record levels. We're at 23 times earnings. But now the equal weighted benchmark, which is really more people buy other stocks, not just technology as well, is only about 18 times earnings. So we're not wildly overvalued, and it's been that way for a while. So I think we're probably ready for a good rally and hopefully a good year in the economy. That's what we're signaling.
No, I mean, exactly. I mean, I think, you know, with how we're set up right now, I think it should be a good year. But I think was that quote, even the best laid plans often go awry. There's a lot of things that could come out of left field,
Yeah.
and push that off course. But yeah, I think from an economic perspective, from what we can see right now,
Mhm.
things look pretty good.
Yeah. Well, let's talk about the economy, Chris. What numbers do you have that we can talk about?
Yeah. So I already kind of mentioned the US Q3 GDP, which was a great number. The University of Michigan's Consumer Confidence
Mhm.
Index that came out and landed at 54 for its preliminary January reading. That was up slightly from 52.9 last month. Still obviously lower than what we'd like to see. but obviously going in the right direction, which is promising. Staying on that note, small business optimism in the US increased to 99.5 in December. That was up from 99 in November. So once again,
Right.
slight increases, but moving in the right direction from there. Go into a little bit of the softer part of the economy, the jobs market. So employers only added 50,000 jobs in December, which was below expectations, which was to add 73,000 jobs. The unemployment rate fell to 4.4%. So the jobs number in December kind of disappointed. And overall, the US economy in 2025 only added about 584,000 jobs, which is averaging about 49,000 monthly.
Mhm.
So it started off really hot and then it really just tapered off towards the end. And that's the lowest pace in over 2 decades. So
Mhm.
once again, that's, I think, the one area where we are seeing some potential red flags or things to keep an eye on, that could slow things down a little bit. Um, but once again, it's an interesting market because it seems like luxury goods, things like that, and we're still seeing a lot of spending, travel spending, leisure continues to be up. So it's a very interesting overall market. So we'll see if that does have an impact overall, if it does trickle up and start to crimp on that. It hasn't so far.
Mhm.
The ISM Purchasing Managers Index of Manufacturing Activity. So this is manufacturing essentially in the United States fell to 47.9 in December. That was from 48.2 in November. So we continue to see that fall back. Obviously, anything under 50 is contraction. So want to see that stabilize and move up, but we'll see from there. The official manufacturing purchasing managers index. So this is separate sides. There's more on the purchasing, separate. That rose to 50.1 for December from 49.2 in November. So that was good. So kind of two interesting numbers there, and hopefully we see that manufacturing activity index increase. Purchasing managers that's going on buying equipment, buying things like that. That's now to expansion again. Hopefully that trickles into manufacturing activity and really helps drive that back into expansion as well. And then finally, the last thing I'll touch on from the US side is the housing market. So the S&P Case-Shiller National Home Price Index rose to 1.4% year over year through October. It was up slightly. It was up 1.3% year over year in September, but obviously still a very weak number. So we are still seeing those weak home prices have really kind of slowed down, tapered year over year. And then US pending home sales index that increased 3.3% month over month in November to 79.2. So that was good to see. So kind of we're starting to see some uptick in home sales as far as volume. Home
Mhm.
prices have still kind of tapered. Obviously, they're still very high, but they have that increase has slowed slightly. Um, but overall, we'll see what brings coming into 2026. I think the housing market's going to be really interesting. It's in a, let's say, a tough spot right now, but if rates can stay at are staying going to stay at 6% or so, with the right now the price of homes, it's kind of going to get to the point where something's got to give, right? Either the home prices are going to have to start to come down. And we'll see that home price index, taper down a little bit, or interest rates are going to have to probably to really start to reignite that sector at this point. So, but we'll see. There's been
Mhm.
surprises in the past. You never know.
Yeah, exactly. Well, good. So it looks like it should be a pretty decent economy, is what we're hoping for.
Yeah. Yeah. I mean, like I said, I think there's the jobs market's definitely one thing we'll look at. But I think overall, when you look at it, I think things look optimistic coming into 2026.
Yeah. Well, and a big part of the change has been the tax policy and trade tariffs. Now, the trade tariffs have raised some prices, and so obviously people, were buying goods or going to the store. They're seeing certain prices higher than before. The big case, though, that eggs have come down like 70% in price. So certain things have come way down, but certain products are still a little bit higher because tariffs can raise prices for sure. But at the same time, it's helping the coffers of the American economy and helping the economy grow. So the hope is that the growth of the economy makes up for price changes, and that's what we're seeing. Now, unfortunately, the president might get the tariffs overturned by the Supreme Court. They were talking of weighing in on it last week, and they didn't. They're coming out with other rulings, but eventually they will make a ruling because the president has been sued over the tariffs, right? And so they have to have, a discussion. The Supreme Court has to decide whether they agree or not. Whether the president has to unilaterally do tariffs or not, or does he have to go to Congress? They may have to refund some of the tariff money. They may have to unwind some of the tariffs. But then I'm sure the president would go right to Congress and try to get that passed. And I think he probably could get it passed with the Congress that he has now. So we'll see how things go. But the whole idea of the tariffs, of course, is to help the American system benefit from the fact that we've created the most dynamic system out there. And for years, we were letting many bad actors have direct control and direct access to our economy without any accountability, right? They didn't have to pay to be part of it. They could use our economy and they didn't have to be responsible in a lot of different ways. So that's what Trump is trying to do. He's trying to even the playing field by using tariffs. And so it seems to be working, but there's certainly dysfunctions and disconnections that happen in any kind of tax policy. So we'll see how things go. Chris, anything else on the economy?
Yeah, well, one thing, I mean, and I think that other interesting aspect of the tariffs that goes, kind of gets put by the wayside, but we saw firsthand, when we had the COVID pandemic and how much that sputtered things up. And a lot of stuff isn't made in America anymore. And in some cases, that's a national defense emergency. So, I think obviously things from a geopolitical standpoint have continued to heat up. There's a lot of posturing around the world. I think, you know, producing goods in America is a good thing. I think, and to, Trump's point, it's we have to put some type of barrier in place because if you're going to produce, let's say, medical syringes, which is obviously a necessity, we need that. But it's, mechanical. It's something you could probably do for 50 cents on the dollar if you go to China. The issue with that is because China, the way that their government works and their economy works is the government subsidizes a substantial amount of that to allow that price to be so low. So essentially, any American manufacturer that would want to go into that business would just, ship it straight over to China because it just doesn't make sense. So, if we did that, if we didn't put in tariffs, we didn't go that route, and something happened, we would be essentially in a much worse position than we were in COVID. If we had any geopolitical tensions or things like that, we would be stuck. So I think it's good we're moving in this direction. There are cases to be made for globalization, for sure. But I think we almost went too far in one direction,
Yes.
and, realized that, hey, essentially it's like, that person that doesn't do anything for themselves. And then, they have maybe a butler or a maid that does everything. And then one day they're all gone and they don't know how to take care of themselves. So,
Okay.
we gotta bring some of that back to the US. So I think that's an important aspect too, that kind of gets left a little bit by the wayside. But the only couple other things that I had more from an international front, I'll just roll on to real quick. Just a couple notes. Keeping on the China note, Rating Dogs, China's General Servicing Purchasing Managers Index fell to 52 in December, from 52.1 in November. So continuously slight contraction there, but albeit pretty minimal. And then in Europe, the German manufacturing orders increased by 5.6% in November. That by far exceeded economists' forecasts, which were for 0.8%, a 0.8% drop. So that's promising. It seems like, tariffs have been on for a little while now, and it seems like a lot of that, the gears are starting to move again. Things are starting to flow. So that's good to see. And then the last quick thing I'll hit upon is in the commodities. We just saw this week oil prices jumped slightly up to about 2%. That came over concerns over Iran's anti-government demonstrations that are going on there, and the potential that that could have supply disruptions for the Iranian oil. So something to keep an eye
Mhm.
on that could, in the short
Mhm.
term, create some volatility in the oil markets. I know, obviously, we do not get Iranian oil, but it does get on the market. Don't fool yourself. So, and then gold is another big player so far this year. It just hit a new record high of $4,629 an ounce. So a lot of people are now are saying could hit 5,000 an ounce in 2026. So that's something to keep an eye on.
Exactly. So that's great news. All the precious metals, Chris, not just gold, platinum, even silver,
Silver.
the kind of the secondary precious metals working as well, right?
Yeah, and silver in some cases has actually done better because silver has a little bit more industrial application than
Hmm.
gold. So we've seen that not only from the precious metals standpoint, the value, but also from the industrial applications. We've seen silver surge in 2025 and now coming into 2026.
Hmm.
So
Absolutely. So, Chris, turning to the international markets, a lot of things are happening on the geopolitical front, which can affect the international markets. We've seen kind of the recovery at international stock markets. Then the dollar's been weaker because of our heavy debt, and I know that we had talked with some of the leaders of Congress during the campaign when President Trump was running for re-election about the need to pay down some of the debt, and President Trump had said that he would pay down some of the debt. So we're still holding out hope that they're going to do that. I think they're going to wait until they get through the midterms to accomplish that. But it seems like you know we are seeing an economic growth. International markets are starting to work again. Um, but now there's some geopolitical tensions that are causing some issues. Now, President Trump, after repeated warnings to Venezuela, who was a very, very bad actor on the world stage, decided based on all the destruction and narco crimes that have been created by the government of Venezuela to apprehend the government president Maduro. So now he is in custody, and they've got him up on charges. And probably no one has caused more destruction in the world recently than Maduro, with all the fentanyl and all the drugs coming in. They've also, because they have a communistic society, let the people of Venezuela fall into poverty. So 90% of the people in Venezuela are in poverty. The oil markets used to be almost 10 times what they are. Venezuela has more oil than Saudi Arabia, but they're not tapping into that market. The U.S. oil companies, with the exception of Chevron, have left years ago. So now President Trump is trying to reform the oil markets in Venezuela. The government is still there. So the Maduro government is still there, but they're on notice from President Trump to work closely with America. And there are some elements in the government that are touring around looking for Americans, and there's still some very bad actors out there in Venezuela. But they're having conversations with the oil companies to try to get them to come back and fix the oil markets. Trump's intention is to get the oil prices down. I think that'll be temporary, though. I think eventually the oil markets will kick in. But that's what they're working on. So they're working on getting the oil companies to come back. Previously, under the Chavez regime, or previous to Chavez, they were doing 3 million barrels a day. They're doing less than 1 million barrels a day now. And it's really sad. So they need to really get that going. So we'll see how it plays out. President Trump is using tariffs and the power of the American government to reform countries, to reform other systems. Some think he's going a little bit too far. I think he probably did the right thing here with all the drug smuggling into America and all the destruction. Now, it's also creating some really interesting and difficult issues for other governments that were aligned with them, like Cuba. So Cuba is on the brink of collapse now because President Trump has blocked any oil sales to Cuba, and they don't have any energy, so they're very, very much struggling. So the government in Cuba might fall. And they've also had a despotic government there for years and years and years, right on the shores of America, about 90 miles offshore the tip of Florida. So they're hoping something can happen there to make things better for the people of Cuba. So we're seeing that happen as well. And then now, because of all the issues with Venezuela, Iran is struggling more and more. They're the big power broker in the Middle East and the kind of a bad actor militarily. And they've now killed apparently over 2,000 dissidents. President Trump has put them on notice that something is going to come to them. They told the Iranian people that help is on the way. Just said that this morning. So those decisions could be very, 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 very quickly. So a lot is going to happen in the geopolitical world, and that certainly could affect commerce, certainly affect the oil markets. All these players are oil players, right? Venezuela, Iran. So we'll see how all that develops and what effect it has on the economy and if it torpedoes the international markets, Chris, or not.
Yeah, I mean, I think that's where a big unknown, all right, coming into 2026 is and we still have the Russia-Ukraine conflict going on. You still have China looming right there. They continue posturing regarding Taiwan, things like that. There still is a lot of potential there that, we don't know. I mean, you take it kind of day by day, week by week, and I think the biggest thing is, looking at the risks associated with it and the impacts that, different outcomes could have and trying to do the best we can.
Yes. Well, good. Well, as far as the economy, I think that's what we have for now. Chris, what do we see out there, and just in the general? What's happening out in the world that we need to talk about?
Couple interesting stories. Kind of staying on the U.S. theme a little bit. The Pentagon just said this morning that they're going to invest $1 billion in L3 Harris's rocket motor business, and that's to help shore up the production on motors, which are used in missiles such as the Tomahawks and the Patriot interceptors that we've sent over to, I know, Ukraine, things like that. So we continue to see the government spending on defense, investing in defense contractors to help shore that up. And it's been a big, I think, area of innovation as well. You have the primes, as they're called, but I think we've seen a lot of competition come in there and challenge them, which has been good to see. And then New York City this week, New York City nurses walked out on the 10 of the major private hospitals in the city. And that was roughly about 15,000 nurses. So that's going to stress an already fragile hospital system. So for any East Coast listeners or in the New York City area, especially this time of year, there's a lot going around. That's going to really stress that hospital system out a lot. So things
Yes.
to look out.
Well, great. On the positive side, Chris, big changes, and it will affect commerce, of course, but in the health area, finally now RFK, the head of the Health and Human Services, along with Dr. Mercari, who is one of the leaders in the health world in the government, they're coming out with some big changes on food, and our food system has gotten pretty crazy. We're eating all kinds of processed foods, or eating all kinds of high sugar foods, and we need to get back to proteins and other types of food that are better for kids. A lot of the food being served in schools is not good for kids either. So there's many, many changes coming out, and we're seeing that all play out here in the last couple of weeks of 2025 and as we begin 2026. So I think that'll make the health of America better over time. So that MAHA movement, they call it, the Make America Healthy Again movement, is started after a whole year of kind of doing research and analyzing everything. I think that's a positive trend. And then I just wanted to point out too, Chris, that things do change, right? So whatever you think is the way it is now, things can change. So if someone's losing or not doing well, that can turn around. So things change quite a bit. The NFL has changed completely. The Kansas City Chiefs are not even in the playoffs this year, and they had dominated the league for many, many years. Our own Chicago Bears, who hadn't been in the playoff in about a decade, they're now the number 2 seed in their division, and things are moving fast. They've won 7 games in a row. In the last minute, come from behind wins. They call them the Heart Attack Bears. So, Chris, if the Bears can turn things around, even the Cleveland Browns can turn things around someday. I'm hopeful for your Browns.
Well, the Browns are a statistical anomaly not in the good way, in being overly bad. If you had a statistical anomaly in the Patriots being way too good for way so long, the Browns are the exact opposite of that. They're both the black swan events of that statistical distribution. But There's always hope, right? That's the great thing about sports. You never know.
Yes. No, it's been a lot of fun, and you see teams that were doing poorly turning around. So anybody can turn things around. If you have a bad go, you can turn things around. So there we are. Um, Chris, back to the economy as we end this here. So what are we doing about all these market trends and everything? So we're in a bull market. So by definition, if we're in a bull market, we want to be fully invested to get gains in the market. So our four-star protection plan has now gone with every portfolio compared to its index on full offense. So we're taking risk now. Usually we're that way 85% of the time, but we had a little stutter step there in the fourth quarter because of the technology names that we're selling off. So that's what the market's signaling right now, and we'll see if the market's right. We hope it's right. Um, we're skewed toward the sectors that are working, so we keep making those changes. We started to add healthcare. We started to get rid of utilities. We were lightening up on energy because energy prices are going down a little bit. So we're making those changes, but the overall general market is rising, and that's the standard process about 85% of the time, Chris, right? So that's where we are today.
Yep, 100%. I mean, I think we're bullish right now. We're on the offense. We're looking at sectors. That's the key right now, is to make sure we keep in the top performing sectors. That's even in a bull market that changes. So, we're continuing to, move in and out of sectors as they change.
Absolutely. Well, and then also, folks, look forward to some new podcasts this year. We're going to do some opening first quarter discussions on different markets, like international markets. We're going to have a few guests on to talk about the international markets. We haven't seen a rally like this in a long time. It could go on for a couple of years. So we're going to have some international discussions. We're also going to have some real estate discussions. Real estate markets have been jammed up for quite a while. And then Trump tried to get rates lowered, and he got a little bit of rate relief, but now it seems like the economy is so strong, it's going to be hard for them to lower rates a lot. Because they'll risk inflation. Inflation is stubbornly high, so we probably don't want to lower rates. So I think the bias is to not lower rates at this point. So anyway, we'll be talking about real estate and how to get the real estate markets going again, and how to get them more affordable. So there's other players that are going to come into the real estate markets and try to make them better. And then also, folks, don't ever forget, go on the fourstarwealth.com website, and you scroll down to the blogs. We have blogging sites with advisors that are putting out articles all the time. And there's an interesting article that just came out about seeking control of the Hollywood soul, the takeover battle of Warner Brothers Studio, and it plays out even in more detail even today. So have a look at that, and we'll keep bringing you new interesting ideas that'll come on the leadership matrix. So anyway, so look forward to those new podcast interviews, blog sites, all the things we're putting out. Keep yourselves well informed. Chris, I think that's all we have for today, right?
Yeah, I think that about covers it.
Okay. Thanks everybody for being with us again for our opening episode of 2026 for today's Market Explained. We'll be back again very soon with another episode, and we will sign in then. But for now, over and out. Bye-bye, everybody.
Everyone.